Welcome to the Off the Tape podcast. Guy Adami joined by Kaitlin Malin, Dan Nathan, and today a special guest, Drew McKnight. Drew is the co-CEO of Fortress Investment Group. You may recall Drew came on CNBC's Fast Money, I believe it was January 31st, from South Beach, Miami, during the iConnections conference. Drew, how are you?
Doing great. Thanks for having me.
Before we get into anything at a high level, the University of Virginia went right in the middle of the lacrosse season. I think they're ranked 5th or 6th in the country.
That's it?
What do you mean that's it?
Oh,
that's
I just thought they were going to be.
I agree.
I don't know.
How do you feel about their chances as being a Virginia alum yourself?
They got a good shot. They got a great team.
Oh, come on. Give me more of the good shot. I mean, how do you feel about the team?
I think they're really good. It takes a lot to win. Got to be healthy. Got to stay together. But I think they got a good shot.
I will say this. A couple years ago, the Georgetown Hoyas men team faced the University of Virginia, I believe, in the semifinals, and they were beat up by that squad.
Yeah, but you're asking Drew this question because he is a national champion.
It's a legend
from the Who's, right? How many national championships you guys have?
We won one.
Oh, you okay?
So I have to say, I'm also a national champion.
Oh, really?
Yeah.
From the Trinity Women's Lac Squad.
Division III Women's
What
Lacrosse.
year is that?
You want me to say my?
Don't dox her, Dan.
It's on the internet. And by the way, if I was a better lacrosse player, I would have been on a team in Syracuse University that actually won 2 national championships in 93 and 95. I should have been in 95. I started there my freshman year.
There's an old saying, if the queen had balls, she'd be the king. The king laughed, he had to.
Fair enough.
We won in 2012 to put that into perspective for you there.
Yeah. So I can do that math, but not that any of it matters.
Well, he won in the late 90s.
Congratulations, and congratulations to Kaitlin. Now, listen,
a lot of hardware.
You're among champions.
I'll say this, Drew, as you probably came to learn, Kaitlin was sort of the driving force of that conference, which was remarkable. We were all there together, 4,300 people. Give us an overview. How did you enjoy the conference? What were your takeaways from that conference that we all enjoyed a couple months ago?
Yeah, it was my first iConnections conference. It was fantastic. My wife joined me also. I had to get her a pass as a companion pass in order to get in the hotel. But it was fantastic. I think the level and quality of the dialogue, not just on the panels, but then the sidebar conversations, the dinners, was probably the thing that I didn't appreciate or underestimated the most. And I think the best thing about it was we really got a lot of value out of it. From those sidebars.
Yeah, no, absolutely. I think that it's really grown and there's so many side events that are happening all within the whole ecosystem of that week. So glad that it was productive for you.
Yeah.
Why don't we talk about private credit? Private credit, we continue to see high demand and interest from investors. At our Miami event, that was one of the top strategies in terms of the number of meetings that investors were looking to take. What do you make of this? How are you seeing private credit in terms of investor appetite?
Yeah, I think if you take a step back and think about the overall investing landscape, we're still while markets are at the highs, it's a fairly treacherous time in the context of making a real macro position, right? You've got inflation that doesn't seem to be letting up. You've got central banks that are in a tough position because you've got real estate that's under pressure, banks that have lent to real estate that are going to be under pressure. At the same time, I don't think they can't ease. You saw the BOJ actually hike today for the first time, or not for the first time, but they're actually in positive territory. That's a very difficult environment. I think where private credit benefits is we're at the top of the capital structure, right? We've got cash paying coupons. We're earning high single digits, low double digits. Just on a cash pay coupon. And so I think in the context of private equity, where you're below that debt, private credit's a much, I think, easier risk reward than private equity.
That makes a lot of sense. I think you said too, you were there, you did a segment with Dan and Guy out on the lawn as well. But you said, we talked a little bit about, it being a place to hide. Do you still think that that's the case, or, tell us your thoughts?
Yes, I think with what you're getting paid in private credit, it's earning, I think, pretty close to private equity type returns without having to take that same risk. If you're the first 50 cents in a capital structure, when I say 50 cents, I mean, you're $0 to 50% of the enterprise value. That's a lot easier if you're earning 8 to 12% there versus at the bottom of the capital structure.
Right.
Drew, let's take a step back here a little bit because, again, as Fortress, you spend a lot of time in private credit, but you have lots of other different businesses. And so let's kind of give us a sense of what are some of these other businesses you're focused on. I mean, listen, the macro environment has been really interesting here in the U.S. You just talked about this inflation sort of situation. Lots of the macro has been dictated about this focus on inflation over the last few years. But you guys are also seeing a lot of other opportunities in other asset classes. Where are some of the other areas of focus that you have away from private credit?
I would say the first thing to talk about, I think, is real estate. For us, it's a expertise. It's an area we've been involved in a long time. I think that's the best opportunity we're seeing right now. We're not calling the bottom in that opportunity. We actually think it's fairly early. I think the Wall Street Journal yesterday or the day before said that 3.5% of the transactions last year in the office space were distressed. So that tells us it's very, very early. I don't think the office market is any better. So I think it's going to get worse before it gets better. So that's the largest opportunity set. Another area that's probably a little more niche-y, but that's been very active for us is what I would call forward flow agreements in mortgages, in consumer loans. These are loans that are originated by companies like SoFi that have historically balance sheeted those investments. They'd historically, some of their competitors would sell those or securitize those. That market has slowed down meaningfully. Banks were a big buyer of those loans where someone else would originate them and the banks would buy them for their balance sheet. And we've followed that market for probably 12 years since its real inception post the global financial crisis. But we hadn't invested in scale in that space. And just in the past 6 months, we've committed over $1.5 billion to that space. And we think it's very, very attractive.
Yeah, much to my dismay, I follow every tick of the bond market now for years, very granular stuff, and understanding that interest rates are critical to all different asset classes. How closely do you watch things? I mean, we've had a 10-year yield that went from 3.5% to 5%, down to 3.8% as we're sitting here today, either side of 4.3%. How granular do you get, and how important is the bond market in your investment theses?
To be honest, we're probably much more granularly focusing the bottoms up credits that we're following and how the credits are performing. The bond market and the fixed income markets obviously set the base rate to what we earn. But from our perspective, we're more fundamental driven bottoms up. And that then sort of informs our view around potentially what we think interest rates are doing. And, what I would say right now, what we're seeing is the companies we are invested in generally are doing well, or okay. So that makes us, and their ability to pass through costs is still quite good, which to us means inflation is not going down in the near term, which means we have a hard time seeing how central banks are going to be able to really meaningfully cut, like what we read some of the macroeconomists have been predicting. I think if you take that a step further, why we think real estate is still relatively early, real estate needs interest rates to go down.
Yeah. Well, let's talk about this because this was on Bloomberg, I think, about a week ago. John Gray, the president of Blackstone, here's the quote: "The perception is so negative, and yet the value decline has occurred. So when you get into the bottoming period, that's when you want to move." And that was a comment about real estate from John Gray at Blackstone. It seems like the headlines coming out of that was like Blackstone calling the bottom on real estate. And it seemed like we're really early on that because, again, we're like 1 year anniversarying the SVB, right? And again, coming out of that, a lot of the focus was on, as rates continue to go higher, what that meant for commercial real estate and the sort of who owned, obviously, a lot of debt on those properties and really what was going to happen there. It just seems like we haven't had the sort of bloodletting that a lot of folks have expected, but you're starting to see some signs that it's actually not getting better. If anything, it's getting a bit worse right now.
I agree. And I think if you read what John Gray said, he said you want to buy in that bottoming period, and I would agree with that. The question is how long the period is and what your investing horizon is. I do think it's fairly early in the number of transactions. I think it was almost a year to the day or a couple days where NYCB received $1 billion rescue from a group of financial firms. If you really think about what that transaction allowed NYCB to do, it obviously stabilized the markets. The regulators were, I'm sure, very involved in that process. But what it really does is now allow NYCB to capitalize themselves so that they can end up selling loans. Our own view is all of these financial institutions, or many of these financial institutions, are still going to have to sell loans. And whether they raise equity or not, they need to delever and they need to get these assets off their balance sheets.
So how are you positioning yourself in the meantime as you kind of wait to see that play out? We're not quite at that point where we're about to see a reckoning. So what does that look like?
Well, you're seeing it, and this is, it's public, but Capital One sold us a portfolio of about $1 billion of office loans last August. That was a process that we started talking to them in January of last year, and they ran through a process. And it was a competitive process, but the reality is on many of these pools, if you think about what it is, and this is consistent whether it's forward flows or these office portfolios, there's a lot of infrastructure in order to compete for these assets, and it's not just buying a building or buying a single loan. Like that Capital One transaction was 26 different loans across the country. About 50% New York, 10% DC. And there's a lot of asset management that it takes to actually work those loans out. And so from our perspective, it's a combination of both analyzing the real estate, but then also analyzing the actual loans and the actual debt documents.
So I look at what happened this time last year and then fast forward to today. My sense is, as these small and regional banks have been hamstrung to a point and the larger banks continue to get larger, private equity, this has got to be sort of a sweet spot for you in terms of, where things are and sort of the bifurcation of the banking system. Can you speak to that?
Yeah, I think the opportunity set is very, very interesting. I think the key part is having capital, right? I think there's been a lot of talk. Some people ask about private credit and whether there's a bubble. I think you have to take a step back, and private credit has grown immensely, and it continues to grow. But that's also in the context of the banking system shrinking, right? If you look at what one of the byproducts of that Silicon Valley Bank, First Republic unwind was the deposit market was it showed just how volatile that deposit market is. Mm-hmm. And now that you can actually withdraw your deposits on your iPhone, it's a totally different world. And I think what that did was it made banks realize what they could and couldn't do with their own balance sheets. And I think we've seen them not just in real estate, but you've seen banks shrinking their balance sheets and pulling back across everything in credit.
Let's talk about the banks for a second here, because I know a lot of our listeners, care about this. You just mentioned, a point about what would be good for the credit markets as it relates to rates. It seems like if you look at just how the banking sector has acted in the public markets, like JP Morgan is making new all-time highs every day. It's up, 45% or so from its October lows. Think about that versus the NDX. And I'm just using the NASDAQ 100 because we know the names that dominate that. It's up much less. It's up 28%, right? If I look at the BKX, it's still well off of its 2021 highs, but it's up 40% or so. It seems like no matter what the outlook for rates are right now, it's good for the banking sector. Does that have to do with like some of the consolidation that you've talked about, like you were just talking about?
I think that's a great point. I think when you talk about the banking sector, I really think you have to actually identify what the banking sector is. Mm-hmm. JP Morgan, this is probably a phenomenal time for them. Yeah. If you look at, I think right now there's 4,500 banks in the U.S., mm-hmm. but the top 10 make probably 75-80% of the profits. I think that's only going to be continue. And I think one of our theories is that the number of banks we're going to have as some of these smaller banks deal with balance sheet issues and they don't have the ability to earn their way out of those balance sheet issues, you're going to have a lot of banks eventually have to be purchased. And I think even if you take a step back and look at what happened last year, if you remember those first few processes, Silicon Valley Bank, they actually didn't allow JP Morgan or Goldman Sachs or Morgan Stanley to even be in the process. And Silicon Valley, because they wanted them to be bought by someone else. They didn't want to make JP Morgan stronger. What ended up happening, First Republic didn't have a buyer, and they, I think, more or less called JP Morgan and said, will you put a price on this?
Right.
Right. And that just, I think, is very instructive of how this likely plays out.
Thinking about this consolidation, the concept of these barriers to entry, talk about it with respect to Fortress and the Fortress business. I think you mentioned this in Miami, but there's an increasingly high barrier to entry when it comes to starting a new firm in private credit and private equity. What do you attribute that to?
Look, it takes a lot of people to actually administer these loans. And, one of the things we talk about when we do private credit versus even public credit, right? If you're looking at public credit, you can do that with 3 or 4 people and a Bloomberg screen. Private credit just takes a lot more infrastructure to actually originate the loans. You're not buying a bond off of a Bloomberg screen. You're actually originating a loan to a counterparty. You're monitoring the loan. You're agenting the loan. It's just a much more laborious process. I also think just like the regulatory process for banks has gotten higher, I think the regulatory environment overall is higher, and those just create barriers to entry. I also think as you go through a real credit cycle, and we haven't seen a credit cycle outside of a relatively short period in COVID, we really haven't seen a credit cycle since the global financial crisis, which is a long time. And you have a generation of investors, some of whom haven't really seen a credit cycle. And I'm not saying we're going to have a big credit cycle. I think there will be defaults, particularly in real estate. And I think as you work through those, having the infrastructure to do that is going to be, you're going to see who really has it and who doesn't.
So in some ways, I mean, you're not hoping for that by any stretch of imagination, but to the extent that we were to see a long-awaited credit cycle, it's right into the sweet spot of where you're setting up for and what you're capable of investing in.
Oh, it's a much better investing environment for us and an opportunity set for us than relatively low defaults. I mean, if you think about, for us, one of the harder periods was sort of a 2015 to 2019 timeframe where interest rates were really low, credit spreads were really tight, and defaults were really low. I sort of, at that time, we talked about we felt like, while we didn't have any sort of prediction on the timing, eventually interest rates were going to rise, eventually defaults would rise. And we sort of referred to that as a time where we were playing defense because we were trying not to do something stupid. This is a time where it's really more an opportunity for us to play offense.
So let me ask you a question. What should people be looking for? Like, I know what I look at. There are a couple different instruments, and I'm not suggesting I'm right. But for example, LQD is something that I have on my screen every day. More interest rate sensitive, but something that I look. HYG, the high yield credit ETF, is something that doesn't move, but when it moves, it typically is the prelude to something. For the folks listening to this, what instruments, if any, should they be looking at as sort of a window into a potential move in the credit world?
Look, I think those publicly traded high yield ETFs are the ones to start with. I think the BDCs, the publicly traded BDCs, are another one. I think not just in where those stocks are moving, but also in what they're actually reporting from a performance perspective in their portfolios, which again I would say is performing quite well. I think if you go and look at some of the REITs. And those that own real estate debt, that's not telling you the same story. And I think that's indicative of what we're seeing as well.
So here's one. This was in Bloomberg on March 19th. Commercial real estate CLOs near brink as distressed loans surge. So again, CLOs, collateralized loan obligations, not a term that we've heard a lot. We talk about this period that we've been in that you just mentioned, like we really haven't had a credit cycle. When you start seeing headlines like that, okay, and there was some data in there, and it's kind of speaking to some of the things that you were just talking about, like, what does that say to you a little bit? Because Guy and I go back to this, and we know like a lot of the folks who are Kaitlin or iConnections customers. I mean, these are the products that they deal in. Guy and I are often talking to equity-centric sort of folks. But when we start to see those sorts of headlines again, our antennas kind of get up a little bit because we started seeing stories about defaults in the CLO market in 2007, but everything was really fine then. It wasn't until things really got going in 2008. So again, our antennas get up when we start to see some stuff like this.
Look, I think to really take a step back, number one, I agree with it. I do think it's an indicator of what's going to come. One of the things that has allowed some of the real estate market to maybe delay some of the defaults was they're not necessarily refinancing the loans, they're just extending the loans. So the lender doesn't have the ability, they don't want to take back the asset. The equity doesn't have the money to pay the asset. So they just extend the loan to avoid what is going to eventually be a reckoning, particularly in spaces like office. But I think if you take a step back and you really think about who are the biggest beneficiaries of low interest rates and low credit spreads, I would posit real estate developers and speculators were probably some of the biggest beneficiaries of low interest rates. I think part of the potentially Goldilocks scenario is I don't think there's a really great scenario if you own real estate levered, right? That there's going to be a reckoning, but I don't think that necessarily has to translate into middle America, because I think if you think about who benefited from those rates, it was the real estate speculators. A lot of middle America, a lot of, I think what we're seeing in sort of the populist angst is a lot of people in America didn't benefit from that, but that also means they may not take a lot of pain as we go through that process. Our own view is that destructive, creative destructive process of the U.S. bankruptcy process is a very good thing. It allows the capital structure to emerge. And so I think that's probably the best thing for real estate. long term. It just might not be best for the folks that own real estate levered.
What's your sense of timeline around how this will play out? Is this something we're expecting to see in the next 6 months, a year, 2 years? And Fortress's view, is that contrarian to others, or is this kind of mainstream?
I think you're starting to see it. I think you will continue to see it. I think, the folks want to sell assets. They want to delever their balance sheets. The issue is, do they have the capital? Do they have the capital reserves to do it? But you're seeing it, and I think the scary part is, and like we saw last year, if you think about that Silicon Valley Bank process, that was really a handful of banks that had very specific asset liability issues. It wasn't, but it still led to deposit flight across the entire banking industry. I think the real issue was, if you go back there, what happens if the entire industry is looking at their real estate exposure? And Dan, to your point, back in the financial crisis, if you remember, people were looking at what Citibank did or what B of A did, and then looking at every single bank and marking that bank the same way as whoever it was that sold those assets. When you have that, that's when you start to see contagion, and I do think that is a real risk in the banking sector.
How do you avoid contagion when it comes to, people are looking, they're reading headlines, Dan's pulling out headlines. I think a lot of people do think of SVB when they hear this narrative. So how do we avoid that kind of scenario?
And, that's a great question. The last time we actually really had fear of contagion was during COVID, right? And look at the tremendous measures from a monetary and a fiscal standpoint, and we avoided that. And then even SVB, again, some of us with PTSD, so I'm glad you brought this up, from the financial crisis, we're like, there's no way that those banks can go under and we won't have reverberations in the financial system.
Well, you're going to have winners and losers. And again, I would guess JP Morgan is doing pretty well here. It doesn't mean the stock couldn't trade down if we go through a period like that, but I would imagine JP Morgan will emerge from it stronger, right? Wells Fargo will probably emerge from it stronger. But if you also take a step back, I mentioned the U.S. has 4,500 banking institutions. I think Canada has like 10. And I think the UK has like 90. And so we can have a healthy banking system without having 4,500 banking institutions. Credit will be available to middle America. You'll be able to get a loan. I'll be able to get a loan. That doesn't necessarily mean the U.S. is going to emerge worse, but it might mean there's got to be some pain, and a few are going to get bought and go out of business.
Yeah, you mentioned that you guys do obviously a lot of bottoms-up fundamental work, a lot of investing. So, we're recording this. The Fed is meeting as we're speaking. Probability of any sort of movement is zero, right? Rate cuts have been pushed out 50-50 now in the June. If we look at the CME Fed Funds Tracker here, coming into this year, we think about through the lens of the stock market, in that mid-December presser that Fed Chair Powell had, that just lit a fire under equities because folks just started kind of pulling forward those rate cuts. Now they're pushed back, but the stock market's at all-time highs. So when you think about that, I'm just curious, how are you guys thinking about this kind of rate hiking cycle? Obviously, the pause has been the thing that has really electrified, equity investors and the like. It just seems like everything that we look at across our boards, complacency. And I'm just curious, if rate cuts get pushed out for 2024, what do you think is going to go on with risk assets in general?
Well, I think it's just going to depend on what the risk assets are, what the actual underlying businesses are, because I think part of the reason the equity markets have held in despite there being a longer pause is the actual companies are performing. If you look at inflation, you look at earnings, they're actually beating and reaching their earnings. I think the real issue is when you start to see that start to slow down is where I think the broader equity markets can get hit. Now, if we have some sort of banking crisis, if we have some sort of real estate, I think that could slow things down. But I do think the equity markets, or at least the performance of equity markets, can hold in okay while we also go through some sort of period and sort of regime change within interest rates.
I'm going to switch gears slightly. Recent news at the end of the year, December 2023, that Fortress acquired the pod shop from PineBridge. Talk about how that's added to the business. We have institutional investors in the iConnections community. That's all, the buzzword around pod shops. Is this something that they should be looking at? Obviously, fees are a consideration as well, but how does that tie into Fortress's broader business?
It's a good question. And to take a step back, Fortress is in the process of buying ourselves back from SoftBank. We're currently owned by SoftBank, wholly owned by SoftBank, but we've agreed to buy Fortress back from SoftBank alongside Mubadala. We hope that closes early second quarter. And as a part of that, we sort of took a step back and said, what are we doing with the business? I think for us, the real important thing is becoming more relevant for our LPs. I think if you look at a trend that I'm sure you're seeing and you're hearing is LPs want to have fewer relationships with the same people. And what I mean by is they want to really grow their existing relationships. And so being more relevant, really being partners in the true sense of it, talking about best ideas, talking about infrastructure. And so as we think about our business more broadly, we want to be more relevant for our LP relationships. That specific transaction, I don't know that we would have said we're going to build a multi-manager business. It was really, to be honest, right place, right time. Todd Rapp, who had built that business, actually is in the same building we're in Dallas. And Todd and I were friends. He had a situation with PineBridge where he knew they were looking to potentially divest. He had some other capital partners that were willing to extend their commitments. And so it was really a sort of right place, right time. And then I think it all came together with a guy named Jeff Runfeld, who was at Balyasny and who decided to leave. Jeff also happens to be in Dallas, and Jeff helped build Citadel's global equities business. He ran equities for Citadel for a long time, and then ran equities for Balyasny. And so it was really right place, right time where we felt like we could try to do something a little bit different. And I think Jeff saw that opportunity as well. And I think versus going to a more established firm, Jeff decided to come to us because he wanted to do it a little bit differently. I think the real issue there is Jeff's non-compete doesn't end till this September, so he hasn't started yet. So we've been doing a lot of meetings, doing a lot of planning. I think it gives us the opportunity to really build the infrastructure around it so that when Jeff joins us in the fall, we hit the ground running.
You hear this? Equities in Dallas. Come on.
Right, there you go.
Equities in Dallas.
Is that a good thing?
Come on, you don't remember?
Liar's poker,
baby. Like that was the big joke, right? Like
was
you got
that ha joke?
No, that wasn't good.
No,
you got
true.
shipped out to equities, but you're doing it, Drew. I mean, how about that?
But that goes. I mean, that's 1980
There's
shit.
Michael Milken's family office is headquartered in Dallas now. There's a lot going on.
Listen, there's a lot going on.
I got married in Dallas.
And
what was
I don't know. I mean, 24 years ago.
He's still married, and he's still married.
You just had your anniversary.
You heard that, right?
Yeah, I did.
How about that final trade last night?
That was sweet.
No, nothing?
Drew, what Dan said is happy anniversary to the luckiest woman on the planet. I'm sure that's just as romantic as can be.
You know what? She didn't see it. She
Thank
watched
God.
the show. I've been
You're
on
lucky.
the show. How many years I've been doing the show with you?
15 at least.
Yeah, almost 15 years, and I think she's watched like one episode. How about that?
Smart woman.
That's how we stay married for 24 years.
That's how you do it.
So let me demystify this a little bit. I mean, people here, they understand what equity traders are. They understand what maybe commodity. Private credit is sort of its own animal that I'm sure intimidates a lot of people. Typical day for you, and make this accessible to the people listening here.
When we talk about barriers to entry, part of the reasons the barriers to entry, it's not necessarily rocket science. It's just a lot of process. You can't turn on a screen and click on to buy a stock or even a bond. You have to structure the loan. That means you're writing a credit agreement. So this is a bilateral agreement where we're actually coming up to terms. It's not just economic terms in terms of what that borrower is going to pay us, but it's also covenants, right? So they have to perform at a certain level. If their performance deteriorates, it gets us to the table, right? If they've got a covenant breach, that means we get to reprice the loan. So within private credit, I think a well-structured loan, you want those covenants to get you to the table if things slow down. And ultimately, one of the things that I think is difficult within private credit to really discern who's good and who's bad is if you don't have defaults, it's hard to know who's doing a good job. And defaults aren't necessarily a bad thing if you've got a well-structured loan. We've been doing private credit since 2002. We've originated over $90 billion of credit, and our average recovery on defaults is 103 cents. The difficult part with private credit, it's not about your winners paying for your losers. If you think about an equity portfolio, you want to ride your winners, you want to cut your losers, but your winners pay for your losers, and you're going to have losers. Credit is the opposite. Right? In credit, it's all about making sure you're mitigating your downside and making sure you get your money back because you don't have those winners, right? A good loan pays you 10%, 11%, and then they give you your money back, and then you got to go redeploy it. And so the real performance within private credit isn't about how good your winners are. It's about making sure your losers don't hurt the portfolio.
Yeah. I mean, in your case, do you consider that the attention to detail, the focus, the secret sauce of Fortress, or what makes you stand out?
I would say that. And then I also think, our asset management team. So we have a separate process. So you think about originating a loan. That's the easy part, right? You gave someone money. Now you've got to get the money back. You've got to manage the portfolio. And so we have a team of 150 people that we call our asset managers that aren't responsible for making new loans or not responsible for sourcing new investments. They're solely responsible for managing the existing portfolio. In low default environments, it's very easy to do that. It's hard to differentiate that. But fast forward to COVID, where all of a sudden you've got real triage going on in a portfolio. You've got credits that have real issues. You've got to work through them. And you can go from managing one person managing 20 or 30 names because they're all performing to 3 people managing one name because it's a full-time job as you're working through, think about like a restaurant company in COVID where you're really working through payroll, you're working through, leases. It's just very, very, very heavy lifting. The issue is it's sort of a Noah's Ark type of environment. From our perspective, we've really built our business to be in that Noah's Ark. We're ready for the flood. It means you have a lot of redundancies in certain times, but it means you want to be prepared for those times when things are more volatile.
So there are signs that you've seen historically that suggest, okay, we're about to get really busy right now, or we're about to get really busy a month and a half from now. Are you seeing similar
on the real
signs?
estate side? Absolutely. On the corporate credit side, again, I think it's fairly benign for now. And the question is if there will be contagion. But on the real estate side, absolutely.
And before this is my last one. You mentioned something. It's fascinating that too big to fail was clearly a thing. I mean, we cannot have this again. Yet the irony of the situation that you addressed earlier about all these banks, but the top 10 banks, that's exactly what's been created now. And you can opine on that or not opine, but the painful reality is we've backed ourselves into the situation that we wanted to avoid all those years ago.
I totally agree. If you think about even what they did last spring, right? They didn't want to guarantee deposits. They didn't want to guarantee deposits over $250,000. What did they do? Guaranteed deposits, and I think that's what they had to do. Again, I think there will be bank consolidation, and I don't think that's a bad thing. And I think the question is if politically we can allow that to happen, because there's an argument that the banking system got better when J.P. Morgan bought First Republic, and so I think we just have to decide: do we want to decouple from that, or are we going to stick to protecting those weaker?
Yeah, no, you talked about Mubadala, that relationship. iConnections, we're hosting events globally. We have an event in Singapore. We'll be hosting events in the Middle East. What does that look like for you when you think about Fortress's business? Again, fairly, what you're doing is typically U.S. Leaning. But
and SoftBank, we've been known now over 6 years by SoftBank. They were a great partner. We did not push that transaction. That was really something. And if SoftBank was exploring their options to sell Fortress. One of the things that was really important to us was, we didn't want to be sold just to anyone. We weren't going to allow an auction. And one of the things how that process played out is, even though SoftBank owned Fortress, in order for them to sell Fortress, they could agree to sell it, but then Fortress had to go to all of our LPs and get our LPs to consent to that because there was a change of control. And so for us, Mubadala was really the partner that made sense. Mubadala already owned 10%, so they knew the business. Hani Baruch was on our board, so we knew him very well, and we were very comfortable with that relationship. But from our perspective, if you think about opportunistic capital, you think about pools of capital that are growing, Mubadala's a pretty good partner. And I think as we look at where the world is going, we feel like the Middle East is a bigger and bigger part of it. And so from our perspective, we feel like they're really a key partner as we grow the business going forward.
It's interesting, our partnership with iConnections over the last few years has really kind of helped Guy and myself kind of expand our vision a little bit to just how interrelated we're becoming, from an investment standpoint. And again, I think it became aware to folks like us where the money came for some of the bailouts during the financial crisis, but where the consistent money has been. And now when I think about a lot of our friends and peers who run firms like you do, how much time you spend outside the U.S. engaging with potential investors and the like. So it's definitely really interesting for us to be exposed to that through iConnections. And Guy and I just want to thank you, Drew, for coming here to our studio. We did it from the Global Alts Conference in Miami. You came on Fast Money. We saw you up there on stage. We're like, we got to get you back on the show and get you on the pod. So we really appreciate you coming here and being on Off the Tape with us.
Thank you, guys.
Thank you, Drew.
Thank you.